Good morning, ladies and gentlemen. My name is Tan Nathanukul. I'm the board member of Thai Business Association and also Vice President at CP Corporation Vietnam. Thank you and welcome to how to be well prepared for tax and transfer pricing audit based on common practices with Grant Thornton. The Thai Business Association and our partner chambers and association are very delightful to welcome you to this webinar. Right. Today we have Mr. Do Wu Bao Khan and also Mr. Wing Tan Thai, expert from Grant Thornton, to come and share with us their understanding, their insight, and the best practices. A bit of house rules. The team will be releasing the recording of this webinar later. Together, they would also send another version of slide with some details to the all registered participants. So meanwhile, please feel free to type in your question on the chat box as the webinar proceeds, and the team will pick up and answer some of them during the session. For the rest, they could get back to you through email later after the session. Thank you very much. Hope you benefit from this. And over to Grant Thornton team, please.
Good morning, ladies and gentlemen. My name is Kang. Please have your patience for a while. We are having some technical issues over here and should be fixed in momentarily. Okay, good morning, ladies and gentlemen, and all our value clients and potential clients to join our webinar today about how to be well prepared for the tax and transfer pricing audit. It has been a pleasure of Grant Thornton Vietnam and myself in order to provide you the most up-to-date technicals and the updates on the legal and the tax legal frameworks as well. And today our webinar could be contains of the first sections that would be myself will share with you the updates on the new Vietnamese transfer pricing regimes, and the second sections Mr. Thai would be pleased to share with you the practical concerns and how to be well prepared for a tax finalizations. The third sections coming up would be our experience sharing and case study on a specific tax and transfer pricing audit. And the last section, section 4, would be for your questions and answers. Okay, and we would assume that everyone should be ready for our webinar. And here's the first sections that I would be pleased to introduce to the new transfer pricing regulations update. Before we get into the actual tax audit practice that we thought it would be very helpful in order to keep you up to date with the most recent the tax and the transfer pricing regulations in order to understand the law prior to getting ready into the actual tax update and the transfer pricing. And the transfer pricing right now, the most up-to-date transfer pricing regime in Vietnam is reflected under Decree 132, which is issued in November 5th of 2020, and which would take effectively from the tax year 2020 onwards. Decree 132 has been issued in order to replace Decrees 120s, which replaced Decree 20/2017, Decree 68/2020, and Decree and Circular 14/1 in 2017. And Decree 132 has provided certainly updated to the Vietnamese transfer pricing regime, which we would be pleased to bring it up in a few moments. Okay, and the first thing we would like to bring up is the update on the definitions of related party. It's the update on the definitions of related party. So previously, the Vietnamese transfer pricing regulations has only mandated the relationship and definitions of the related party as between enterprise per enterprise and vice-versa. And from now on, Decree 132 has also mandated that the related party relationship is between the individual enterprises and emphasizing on capital transfer and loan with executive individual. In this respect, any loans that makes between the taxpayer, the enterprise taxpayer, and the executive or the shareholder which hold which individual shareholder which hold 25% of chartered capital, that would be also subject to the Vietnamese transfer, the new Vietnamese transfer pricing regime as well. And that would be the highlight that we would see as very important in order to note from your compliance. So every transaction, every transfer of capital, and every loans between these units from now on has to be compliant and has to be declared accordingly and properly in the annual compliance document as well. The next updated that we would like to highlight is the very important ones, in which is the increase of the maximum deductibility of the interest expenses. So previously, Decree 20s and Decree 20s and Decree 68 has mandated that 20% of the EBITDA, which is the interest before the earning before interest, tax, depreciations, and amortizations, that would only be as considered as the deductible interest expense during the tax year. Decree 132 has revised this regulations as well. In the extent that the cap of 20% previously exists from 2017 to 2019 has been raised up to 30%, and the basis has been now considered the net EBITDA prior to in lieu of the EBITDA as previously stated. So which create more deductible room, less we can say, for the taxpayer in order to control and maintain your deductible interest expenses. And we have been mentioned that in some of our newsletter before, and if that is that's your interest, and we will be pleased to provide that to you later on. And one of the new things in Decree 132 as well is that the non-deductible, which is the amount that exceeds the 30% of the limitations on from 2019 onward, that should be allowed to carry forward into the next 5 consecutive years. So if you are looking at the diagram that we stated over here, that you would say, for example, in 2019, for example, a newly established enterprise, and which incur a lot of, let's say, interest expense, and you do not have sufficient earning in order to cover your operations, and that is the so the 2019, so the cap of 30% EBITDA is existed, and there's an amount, a partial amount of the interest expense incurred in 2019, that would be considered non-deductible in the same year. And from now on, under Decree 132, the non-deductible interest expense that would be allowed to carry forward into the next 5 consecutive years in order to fulfill the 30% EBITDA. So for this example, if in 2020 and 2021, the taxpayer has been expanding its operations and has been gaining its EBITDA. So the gap of 30% EBITDA, that would be increased as well. And for example, the interest expense incurred in 2020 and 2021, respectively, that would be under the EBITDA, so that you wouldn't have a chance in order to utilize the non-deductible interest expense in 2019 and fill up the cap in 2020 and 2021, respectively. Now, and we would say this would be a new regulations. This would be a new regulations in order to create a more room for the taxpayer in order to have a proper plannings and for both of your transfer pricing and for your corporate income tax as well, in order to utilize all of the network all of the expenses arise from the working capital. The next point that we would like to highlight is the narrowings of the arm's length, or maybe we call in very simple terms that we call the market range for pricing in controlled transactions. Before we get into that point, we would like to highlight that the main principle of the transfer pricing, not only in Vietnam, but also globally, is that we propose the arm's length principle, in which the price, or maybe the margins of the taxpayer incur with the related party in your transfer pricing acts of conduct, that should be similar to the price, or maybe the margins of the non-controlled transactions, or maybe we call it the market range. So which means in the simple words that we could say, the price in the transactions with related party and the margins of the taxpayer engaging in the related party transaction, that should be similar to the market range. So which is the main principle that we need to focus over here. So in order to perform that, there should be a range. And so you are not going to duplicate your taxpayer and make a comparisons, right? And what we would do is we would find another similar transactions, similar control transactions, or the similar, let's say, comparable entities in the market in order to establish the range of pricing or the range of profit margins. And you will see if you fit into the range, and that would assure your compliance purposes. And under decree, the previous range has mandated from the 35 percentile to the 75 percentiles to be considered as compliance. And however, in Decree 132, 2020, things has changed a lot, because now the acceptable range, let's say the acceptable market range under the Vietnamese transfer pricing regulations has been moved up. So the minimum threshold has been moved up from the 25th percentile to the 35th percentile, which also require taxpayer, again, to do a very proper planning, the tax planning, the transfer pricing planning, in order to fit within the range and to assure the transfer pricing, your transfer pricing positions as well. And because the minimum threshold has been lifted up, so that may require taxpayer to be more careful and more and create more proper planning in order to fit into the range again, and making sure that everything that's go on to a year-by-year basis analysis that should be appropriate. Now, and last but not least, we would like to update the so for in general the filing requirement under the Vietnamese transfer pricing regulations has has remained similar to the previous year. So that taxpayer that engage in, except for all the threshold that allow for the small and medium enterprises to exempt yourself from the preparations of the local files and all the master file. Taxpayer in general engaging in related party is required to prepare Form 01, 02, and 03. And together with that, you also need to maintain annual local files and annual master files in order to add your premises, and such material would be required during the tax audit. And especially is the local files that create the legal basis for your declarations in Form 01. As you may be into before, Form 01 require the declarations of the related parties, relationship, transactions with related parties, the market value, and the transfer pricing method apply in order to examine the appropriateness, or we call the arm's length natures of such transactions, and the basis for analysis that would be accordingly documented in the annual local file. And there would be a lot of risk that the taxpayer might expose during preparations of the local files, which we will bring it up to you during the later sections. Now, in Form 01, in the adaptations of the net interest expenses carry forward principle that is newly mandated in the regular 132, Form 01 has been provided under the new format, in which the taxpayer also is required to declare the principle of the tax of the interest expense carry forward as well. So you need to declare the tax deductible, the interest expense deductible for the current year, and if applicable and if possible, that also need to carry forward for the next year, as to carry forward from the previous year as well, and to be carried forward from the upcoming periods. Now, have been talking about the issuance of the new Decree 132 has been opened up a new spectrums for the tax audit, and well, as per our observations, that the Vietnamese tax authority has been how we would say that has been becoming more and more sophisticated and more aggressive during the transfer pricing audit. Now, the non-compliant consequence that I would be going through all of the consequences right here, and all of the challenges that we might have during the tax and the transfer pricing audit would be discussed later. So the first one is any differences in informations between the declarations and between the analysis that would highly to trigger the aggressive challenges from tax authority during the tax audit inspections. Now, we would like you to place yourself into the tax authority, into the very suspicious, the tax auditor, I mean the tax authority, when they're coming up to your premises, you're coming up to your office to conduct a tax audit. Now, and the every inconsistent between material, between declarations material and analysis material, that would be raising the suspicions from of course, from the taxpayer, and that would again raising the very aggressive challenges for tax authority, because you are declaring one way and you are analyzing on another ways. Okay, and leading to the second consequence, that the tax authorities that may deem the adjustment of the control price toward the favorable market price. And let me be, and again, the adjustment of the tax audit is going to be in the non-disclosure basis, which means the tax authority, they maintain their own database, and the disclosures of the database is not going to be required. The taxpayer, they can use their less so-called the secret database in order to make the adjustment and deem the profit margins of the taxpayers. and how and more, and nonetheless the other consequences that could be listed that will be include all of the bad tax precedents for both Vietnamese entity and the group as a whole. Now, not to mention all of the transfer pricing cases that has been listed under the newspaper and pop out in your newspapers. And now that would create a very bad precedence for not only the Vietnamese entity, but the group as a whole in order to, because you have violated some of the local rules you're not following, and moreover, you are going to do all the transfer pricing, which is going to be very bad for the business and doing the business in Vietnam later on. All right, and that is would be the updates on our transfer pricings on the transfer pricing legal basis. And now we are coming back to Mr. Thai for his presentations.
Good morning, everyone. Good morning, everyone. I'm Thai from Grand Thon, Vietnam, and thank you, Pen, for a very great presentation. Today, I'm going to present about how to well prepare for the tax audit. But at the first section, I'm going to talk about the tax finalization, because tax finalization is a very important part when for you to prepare on the tax returns and prepare on the necessary documentations, so you can support for a tax audit in the future. So first part is about the issues that you, the practical issues that all of the company, I believe, that you will face during doing a tax finalization. As you may all be aware, the 3-month period from the 1st of January to the 31st of March of a calendar year is considered as a peak season for the most of an accountant, since this is the period for the preparation and submission of the corporate income tax return. The deadline for this return is the last day of the 3rd month from the end of a calendar year or the fiscal year. Annual tax finalization is typically regarded as a heavy-duty job for the accountants and involves significant level of both technical and non-technical issues, which can affect the company's tax position for years after the submission. So in this presentation, I will explain why the annual tax finalization involves significant challenges and provide a brief outline how taxpayers can be well prepared for coming tax finalization. The first part is about the technical issues. Accounting and tax principles, they are totally different. There are many differences in account and tax principles. So this usually leads to the increase or decrease adjustment of the taxable income, treatment of assessable income, deductible expenses, accruals, provision, so on. Such differences should be well managed in the current year and monitored throughout the next tax years to avoid any over or declare tax declare amounts. The next is the required declaration process. Substantial required documents must be ready by the time of a tax return submission, like the audited FS, the tax returns with several appendices, TB documentations, etc. So all of these dossiers should be ready by the time of submission. So the company should pay attention to this, because there are a lot of appendices in the tax declaration return, like you have a form of CIT form. If you have related party transaction, you have the TB form, the TB appendix. If you have incentive, you have a incentive appendix. If you have loss, you have a loss appendix, so on. The third point is the in-depth technical knowledge. A tax accountant should who prepare the tax return should have in-depth technical knowledge and skills, like substantial reporting information, like accounting transactions, in-depth understanding of the declared figures and supporting information, or the accuracy of the accounting data. Up-to-date regulatory preparation. Tax accountant must also be well equipped with the latest changes in the tax regulations. The application of the outdated regulation could lead to the underdeclared tax payables and penalty. In addition, different points of view and application of a tax law are sometimes required, because not all the time the regulations are clear. Sometimes when the regulations are ambiguous, you have to seek for the official rulings on the similar cases. This is why the accountant who prepare the CST return need to be flexible in handling differences in tax regulations and choose the most suitable method to calculate. How about the non-technical issues? The first one and the biggest one I would like to highlight is the poor internal control. Poor internal control is the biggest issue if the arrangement of the accountant's transactions and the supporting documents are not available. Also, inefficient internal control between the internal divisions could lead to tax exposures and also failures to optimize the tax benefits available. Like I say, in some cases, you have like let me give you an example. This is a tax exposure if you perform a stock take and you find out a loss, or you have inventory loss, or the damage of the finished good. So this is why the internal control between the account division and the other division like stock division, manufacturing division, sales division is very important. So you can well manage the flow of the inventory and the finished goods and prepare appropriate supporting documents. The cash flow is also a big issue if additional tax payable amount is significant. This is why managing well the tax payable and at the same time complying with the regulations and make effective adjustment is a key role here. This would require a tax accountant the fully understanding of the accounting records and skillfully utilize the tax regulations. The last point is the lack of resources. As you may all be aware, at the year-end time, the workloads are normally huge due to a lot of payments, a lot of reportings you need to be made. So while managing the time and the resources is important, because preparing a tax finalization return is not a simple task, and reviewing it is also not easy. So make sure that you prepare all the data, the figures in the tax return is correct and exact at the very first place to avoid any revision and the late submission. So in conclusion, it can be seen that the technical issues require a lot of knowledge, a lot of deep understanding of the internal operation, as well as the non-technical issues require a lot of proactive in controlling the resources and controlling cooperation within the company. So the companies are strongly advised to well manage both technical issues and non-technical issues in order to fully comply with the tax regulations while maintain the good internal control and retain the benefits of itself. So this is the issues of the tax finalization. So I'll give you some points that how the tax finalization have impacts in the future tax audits. The first thing that a tax authority will look at a company when they are doing a tax audit is the submitted tax returns. I mean the figures, the amount therein, and the audited FS. The two factors that we look at it, the first two, and in that event, you will have the appropriate explanations, supporting documents, and account data to support for the figures stated in the FS and in the tax returns. So these factors, the 5 factors, you can totally control at the time of doing the finalization. So if you do this good at this stage, you will reduce a lot of time, a lot of effort, and mitigate a lot of risk when you're facing with a tax audit in the future. The next slide, I'm going to show you that how to be well prepared when you do the finalization. I would like to divide it into 3 stages: before your submission, the preparation, and after the submission. So before the preparation, i.e. By the end of the fiscal year, so we recommend you to carry out the review on the areas which are practically high risk and subject in a tax audit. Like if your company have an incentive, you need to review very thoroughly in the tax incentive. Or if you are in a loss position, you need to review in the back 5 years to calculate, okay, how is the losses and how can we carry forward as per the regulations. Next, supplement any pending or missing documents for justification of the common, not even for the common business expenses, as well as the key expenses incurred during the year. Next, probably estimate the provisional tax payable in the quarters. So the total provisional tax payable in the year should exceed 80% of the total tax payable at finalization for the year 2020, or from the 2021 onward, the provisional tax paid in the first 3 quarters should exceed 75% of the total payable in the finalization. Next, during the stage of preparation of a CIT return, we would recommend you to reconcile the declared figures in the tax returns against the audited figures in the accounting books. This is just to ensure any discrepancies are duly straightforward for the future explanation in tax audit. Second, maintain the detailed working papers of calculation, like tax calculation, the adjustment, the loss carry forward, monitor, the tax incentive calculation or allocation of tax incentive, TP documents, so on. Review and ensure all the returns and its appendices are sufficient for submission to the tax system. Last, after the submission of a tax return, so what should you do? So the first one I recommend is to supplement the documents for the future tax audit. Not all the documents are available at the time of your submission of a tax return. Sometimes you just do not adjust and do not make any adjustment, but later on you submit, you supplement the documentation, the contracts, the agreement, or the minutes, just to make sure that, okay, the adjustment is good for the future tax audit. So please review everything and supplement the documents, or you review and note down any ongoing issues for the improvement. Improve internal control. Internal control and tax planning is very important, as I point out in the first slide. It is like internal training, tax review by a professional tax advisor, a ruling request to a tax authority if the issue is complicated and there is no way to solve it based on the official regulations. So this is the most important stage, the most important stage for any company to mitigate the risk, the tax risks. That is by internal control. So this is everything I would like to share about the recommendations and the practical concerns about how to do the tax finalization works. So I myself would go on to the next section about the tax audit. Tax audit. In this section, I would like to share you about how to be well prepared for the tax audit step by step, before, during, and after. How to do after a tax audit at the company site, and the common areas that the tax authority they would have the tendency to look at during a tax audit. So as you may always be aware, the COVID-19 pandemic is causing a lot of financial difficulties for the Vietnamese government, while the concerns of tax audit, tax penalties, and tax collections continue. So when the cost of non-compliance with the tax regulation should significantly affect the budget of the businesses, a good understanding of the tax audit process will help reduce the risk of tax imposition. So at the first stage of a tax audit, I would like to highlight is the before a tax audit. So what is before a tax audit? Tax audit is normally scheduled in advance by the tax authorities. A company can know about its tax audit plan by proper communication with the tax officer. By doing this, the tax authority may, without doing this, the tax authority may suddenly jump out and inform the taxpayer of a tax audit, which would lead to any unplanned workload or non-preparation or improper preparation of documents for the tax audit. So as a result, the tax audit might impact significantly and negatively on the financial health of the company. In addition, it is recommended that the company should appoint a very dedicated and experienced team which fully understands the operation of a company, understand the account records, and themselves prepare the tax return. So they would proactively communicate with the tax inspection team to understand the scope and review, understand the scope of review and the period of review. So and set up a very suitable strategy for the coming tax audit. And after that, what I would like to recommend you is perform a comprehensive tax review. It's just like after you submit the tax finalization, the company should make a comprehensive tax review on the account and also tax position. Then consider making the necessary adjustments and supplement documents to minimize the risk. And you should have a proper plan to deal with the tax authority. If the company is willing to take the risks and to earn the tax benefits, because not all the time every company make the prudent adjustment. Sometimes you have to face with the risk to earn the tax benefit for the company. This is why a company need an experienced tax accountant or a outsource a professional tax advisor to prepare the very strong arguments for the tax position. Next, during a tax audit, at this stage, the tax authority will carry out field work at the company site for the detailed review. In principle, in the past, the tax authority, they will have 5 working days working at the company's office to do the tax audit. But since the change in the tax administration law in 2019, they will have 10 working days working at the company's office. Please be informed that this is not 5 or 10 consecutive days, but it can be this process can be done in weeks, because due to the reasons like the company cannot prepare the sufficient document at a time when a tax officer come to the company, or the schedule of the tax officer is full, so they will schedule the days of the working forward. So this will give you time to prepare appropriately the documents. So what I recommend here is, first, the company should appoint a senior level or even a GD to be present with the tax auditing team on the first day to welcome them. This is a way to show the respect and earn the good impression on the first day. And then providing the information and documents which are out of scope of a tax audit is very dangerous and could lead to unexpected challenges by the tax team. Hence, the business should assess whether the issues or the matters that the tax authority is challenging is really within the scope of a tax audit. Next, the company should carefully consider any explanations or documents that might contain potential risks. So on the wordings, on the explanations you make to the tax audit team should be well weighed up and down and consulted with a professional tax advisor if necessary. Then to minimize the number of times to be challenged by the tax authority, the company might ask for an extension of time by submitting a letter. This is a very common way to extend time, to buy some time for preparation and carefully review or consulting with the higher levels or a tax advisor, since the tax audit team only has a certain amount of time or to the field work to finalize the issues. You should should remain calm to present your opinions and explanations. Avoid confrontation or aggressive challenges to solve the problems with the tax audit team. You should solve it through conversation very slightly and negotiation. So avoid making decision by yourself. Like if you are a tax accountant, you are appointed by the company to on behalf to work with the tax audit team. Avoid making decision on yourself, or avoid making important explanation by yourself, because it would have negative impact on the outcome of the tax audit. In the worst case, if you're too stuck in the explanation or the arguments of the tax audit team is too strong, trying to discuss in advance with the tax auditors if possibly an appeal or a legal action to their conclusion is necessary. So next, at the completion of a tax audit, completion at the tax audit is when the tax audit team they issue a tax audit minutes. So after working at the company site, they would issue a minutes. Our minutes normally contain of the company's information, the account information, the tax declare figures, and the conclusion that finding out how the company is violation tax. So this is at a time when the tax audit team they issue a draft minutes. You need to carefully read through all of the minutes to find out if there is any misstatement, and that the conclusion is good or not. If you agree with the conclusion of a tax audit, you need to write down your opinion in the company's opinion part at the end of a tax audit minute, and you need to pay the penalty, pay the tax collection, or the interest payment timely as per the regulations. In the event that you do not agree with the conclusion of the tax audit minutes, you should also clearly give your opinions. So in this event, if you clearly give your opinions and with the strong legal basis, the tax audit minutes will be handled to a high level in the same tax authority. So they can further handle like the head of the division of the current tax department, so they can further review and give further conclusion. So in the event that there is still this dispute after the company give its opinion in the conclusion, so it will go to a higher level like tax appeal to a higher level tax authority like the GDT, the General Department of Taxation, or even the Ministry of Finance, or even to the court where applicable. So whatever the outcome of a tax audit result is, once the decision of a tax audit is issued, the business the company should pay the additional tax penalty or the tax collection within the prescribed timeline, and allow and follow the tax appeal procedure in parallel. Because per the regulations, if the company is imposed with tax collection, tax penalty, and interest payment, you need to pay it as per the minutes. And in the event if at the appeal the company win, you will get a refund together with the interest. So at the very final stage, you should decide whether or not an appeal is necessary. If the appeal is necessary, you need to be well prepared for the documentation, for the explanation in the event of an appeal to a higher level tax authority. This is the end of my sharing for the process of tax audit. The next one I'm going to talk about is the common high risk areas that practically can be challenged by the tax authority deal with the tax audit. Because as you may all be aware, the Vietnam tax system requires the taxpayers to conduct a self-tax assessment, self-declaration, self-settlement. Then a tax exposure will be identified by the tax authorities upon the commencement of a tax audit. So a tax audit plan should prevent loss, or TP, or tax evasion, or reduce the tax debts. The most common tax areas that might be challenged by the tax authority are as below. First one is about the CIT. CIT incentive is the biggest issue that all the tax authority they will look at when they do a tax audit if your company has a tax incentive. As you may know, the tax incentive is granted based on the qualification of the location or the encourage industry. So they can challenge you if your industry is not qualified for the tax incentive, or so the location and the package of incentive that you apply is not in line with the regulation, including the tax exemption, the reduction, or the preferential tax rate. If your company had a new investment project or an expansion investment project, and you decide to allocate the income subject to the tax incentive, this can also be challenged by the tax authority, because they might argue that, okay, your expansion is not an expansion investment project subject to the tax incentive, but instead subject to the standard tax rate of 20%, for example, and so on. The methods of taxable income allocation subject to the tax incentive, or the separation of a tax incentive and non-incentive income. Loss carry forward. This is also an important issue that the tax authority will look at for the company who initially established, whether or not the loss carry forward is described within the time limit and continuously, or offsetting the loss with incentive or non-incentive income. Revenue reconciliation between the audited FS and VAT returns. This stage you can do by the time of preparation of the CAT finalization return, as I stated previously. Sales reduction. This is about the policies or supporting documents for the sales reduction, especially for the trading or retailing sectors. Next, about the cost of goods sold. This is normally applied for the company who specialize in manufacturing or even trading, because the tax authority, the tax audit, they will look at the raw material consumption, the price adjustment of your cost of goods sold, or the loss due to stock take, or the damage or expired finished goods, especially for the manufacturing company. Not all the company they efficiently use their resources, their raw material, or turn the inventory fully into the finished good, or even maintain the finished good for fully return into the revenue. So you should have losses under the tax regulations. Not all the losses are disallowed. Sometimes you can enable the losses to be deductible for the CAT if you can maintain a good reason, good appropriate explanation, and good supporting documents. In addition, intercompany expenses, like Han has presented previously, this issue is raising very hard and important for the company with intercompany transactions, especially from the 2017. Like loan interest expense exceeding 30% of EBITDA, or the service expenses paid to the intercompany, like management services, technical support, royalty, licenses, income or benefits of intergroup assignees. These are the subject of challenges by the tax authority, because to prove this, you should have evidence that these services are actually performed, actually supported with the good documentations, and the proof that the benefits that these services can bring to your company, and it leads to the generation of the taxable revenue. Timing of revenue recognition is important, because not all the revenue is recognized at the same time, like goods and services. It's supporting company. The company can be adjusted by the tax audit if the timing of the revenue recognition is not in line with the regulations. Cost, employment costs like salary, bonuses, expatriate employee and staff welfare should be well supported with the good documentation. How about the VAT? The VAT, this consists of two main parts: the output VAT and the input VAT. Output VAT, this is more simple than input VAT. So the output VAT should have legitimate invoices, support documents, payment settlement via the banks or the contract terms. Otherwise, it can be imposed with the penalty, administrative penalties by the tax audit. How about input VAT? Input VAT will be non-creditable if it is not supported with a bank payment voucher, legitimate invoices, or it sends the invoices from the absconded suppliers, non-business related party, non-business related expenses, And the VAT of the investment projects declare not in line with the regulations for the companies who are in the construction stage with input VAT. So how about the FCT? The FCT is also very important because first, the goods delivery term. If the goods the terms, I mean the Incoterm of the transferring goods to the Vietnam's territory, whether or not the seller bear the risk, it depends on the Incoterm or the on-spot import-export, or the goods delivered in the bonded warehouse should trigger the tax liabilities. Goods service supply, like foreign suppliers owe the goods responsible for the advertising, promotion, distribution, etc. Tax rate and tax terms. Tax rate is important. It is the first step that you will decide, okay, how is the tax rate of the transaction of the goods of the service and a net or gross contract price. If the seller bear the FCT, so it is the gross price. Yeah, so if the seller do not bear the FCT, it is a net price and you need to gross up before the calculation of the FCT. How about the next, like the labor cost, like reimbursement? The reimbursement in the event of intergroup assignment can be subject to the FCT. Goods associated with services. If the goods supplied in Vietnam and the Incoterm is qualifying for not being subject to the FCT, but in some cases it can still be subject to FCT if the goods is associated with the installation, training of usage, or maintenance service or warranty, and whether or not the value of the services can be separable from the value of the goods. This will decide how the tax rates are. Other payments, like salary or benefits for the foreign contractors' employees. So let's move on to the PAT. The PAT is rather simple on the first look, but it's not always easy because it contains a lot of details. The first thing the tax authority will decide is the tax residency status of the dispatcher, like tax resident or non-resident or not, and the sources of income and the tax rate. Other benefits in kind and in cash, like bonuses, incentive, or reallocation allowances, tuition fee for the children, or housing benefit, etc., whether or not they are fully calculated for the PAT or not. Declaration and withholding responsibility of the employer. Monthly withholding and finalization with authorization is important, because if an employer does not authorize you to finalize on their behalf, so you need to have a good documentation that, okay, monthly withholding is duly completed, and you and at the year time you will issue a certificate of tax withholding or the income confirmation letter to them. Or if someone authorized the employer to finalize on behalf, so you should need a right way of calculation, especially for the tax relief, including the personal relief and dependent relief. As you all may be aware, this is a change in the relief in this year. From what I observed, a lot of companies is misunderstanding the meaning of the timing of the tax relief in this year, and they do not apply for the whole year. So the timing is important, and the registration of the dependent relief is very important. It is as a proof when you prove to the tax audit, that is, and for deduction amount. And there is still a lot of issues that about the TP and the tax penalties. So for the next part, I would like to return to Mr. Khan to discuss about the TP issue during a tax audit.
All right, we would like to thank you, Mr. Tai, for a very great presentations today and bringing us all of the updated on the tax audit and all the practical observations and proactively create our course of action. So let me come back with you on a very specific case study about and share with you all of the observations and all of the experience that we would have during the a very specific case of transfer pricing audit. And of course, this is derived from the facts from one of our clients, and absolutely for confidentiality purpose, we need to keep it every information at a very anonymous basis. So but still, yes, we have to maintain all the background for the ease of understandings. First off, we were going through a little backgrounds of the clients. So our clients, they manufacturers of the packaging materials. They unfortunately have incurred the consecutive loss for more than 3 years, and they currently enjoying the corporate income tax incentive at approximately, let me remember, about 5 or 10% years. And they have incurred the related party transactions, or in the global terms that we call the controlled transactions, that being they sell approximately 80% of their finished goods to both the overseas parents and the overseas subsidiaries, which is the groups. And the remaining 20% of their revenue is earned from the sales of goods to another third party in the open markets. And besides all of these sales of goods, the revenues, and the companies also incur a management charge that is going through from the overseas parents, and which we will go through in the very next section. So given the so per our observations, it is very good to know that the tax authority, they hate the consecutive losses companies, especially the FDI, the foreign direct investment entities, because in their mindset, that would be there has a bias that the loss company, that they're moving out their profit. There are some acts of conduct that moving out their profitability outside of Vietnam's and into the overseas, into the headquarters somewhere, maybe the tax havens or else. And myself, okay, let me move to the next one. All right, and next off, the client is received during the pre-audit phase. The client is received all of the notice from the tax authority saying that, okay, corporate income tax and personal income tax has been included, and of course, as the transfer pricing is the part of the corporate income tax, as you are very familiar with the procedures, the transfer pricing disclosure form is also an appendix of the corporate income tax finalizations, and that makes TP a part of the corporate income tax declarations and under the scope of audit as well. And on the first hand, that would be comes in all of the documents that the tax authority would need. So the first one is the notice of the tax authority, which is, congratulations, you are in the list of our audited enterprise in this year. And then later on, the tax authority, they come back and say about the schedules, as I mentioned about the tax audit procedures before. They come back with the request for informations and request for all the compliance documents, and the form has been submitted already. They can easily retrieve that during their system. But again, the compliance document being the local file, the transfer pricing, the TPD, the transfer pricing documentation report, including the local files, and if possible, the master files are also being requested as well in the phase, in the pre-audit phase. And also, there's a request for the contract of TP service, and for the reason of that, I would explain later on. And the request for the supporting accounting data is usually the taxpayer would receive, they would call that the tax authority, they would call that as an appendix, which is they provide you as the spreadsheet, or maybe in the Excel format, and going to from the form M1 to form M9. and which require the taxpayer in order to submit all of the informations of the breakdowns in terms of revenues, in terms of expenses, in terms of breakdown on controlled transactions, unrelated party transactions, and etc. So for the first point, we would like to highlight that there is a myth between the associations of the taxpayer in Vietnam that transfer pricing has to be conducted in a very specific tax audit, and that it used to be true indeed, because all of the large cities in Vietnam, or the large provincial tax authorities in Vietnam used to establish their own specialized transfer pricing unit, and we can name it by the General Department of Taxations, the Ho Chi Minh City Department of Taxations, the Hanoi Department of Taxations, and Dong Nai and Bình Dương as well. But the fact is, for the last 2 years, the specialized units has been in this positions, because for right now, all of the personnel, all the transfer pricing specialists in the tax authority, unfortunately, has been moved to every single audit and inspections units, in order to make sure that every single tax audit incurred with the FDI enterprises transfer pricing is always going to be a cover, let's say a cover subjects, okay? And that is our recommendations as well, in order to make you to have more awareness of such subject matter and be well prepared in case of it's just one day and you just randomly receive a saying from the tax officer, a notice from a tax officer for you to supply all of the transfer pricing documentations, and please don't be surprised of that. The second note we would like to highlight is the request for contracts of the transfer pricing service, because for most of the cases, the transfer pricing has to be conducted via a service provider, because the taxpayer themselves would not have sufficient resources in order to do the transfer pricing per se. And it is also a legal matter that the transfer pricing documentations has to be prepared. And we have to emphasize that the transfer pricing documentations has to be prepared before the corporate income tax finalizations. And for most of the FDI enterprises in Vietnam, with the financial year end of 31st of December, so you would have the deadline of the 30th of March in order to prepare proper transfer pricing documents. And the tax and what would the tax authority would base on? The tax authority, they would obtain the transfer pricing service to see the date that the transfer pricing contract is entered into. If the date is going to pass the corporate income tax finalizations, and obviously that is the proof for the regulations violation as well. And so that is the highlights that we would like to note out on the pre-audit phases, because the tax authority, and again, the tax authority has been very aggressive and very sophisticated in their challenges to the taxpayer engaging in controlled transactions. This is from our experience that we would like to share, that why TP has becoming a very outstanding subject matter during tax audit, because from TP, again, as if the taxpayer is not prepared with all of the proper transfer pricing compliance documents, and the tax auditor, they reserve the right in order to deem the adjustment using their secret comparables. And the secret database would also result in a very high adjustment indeed, and that is a single take. We would normally make a joke of that, and we normally see that as a single take adjustment, because instead of going through all of the corporate income tax, going through all of your ledger, your general ledgers, going through all of the transactions all night long, And if in case the tax authority is not, the taxpayer, I'm sorry, is not prepared with all of these sufficient documents in the tax authority, they can only easily deem the profit margins and make a huge adjustment toward the company's profit margins. And that is why transfer pricing is going to be a very, let's see, a very resourceful adjustment for the tax audit, and we need to be prepared for that as well. And during the audit, there are several adjustments that we would like to bring it up. As you will see, the first one is the challenges on the sale transactions, as we mentioned before. And the second thing is the challenge on the management charges. The first thing, so let's move on. The first challenges in case the tax audit is going to your premises is they would look at your general ledgers, of course, during the pre-audit and the general and the document submissions phases, that that they would see. It is the principle that we call the comparable uncontrolled price method that should be prioritized to apply in case of the tax audit rather than the profit margin method. This is very technical indeed, but we would like to give it a very simple words, is that the direct comparison is that one transaction, the price of the controlled transactions is going to take a basis to compare with the similar uncontrolled price transactions. Or in the simpler words, that if you are selling a similar goods to related parties and you are selling the same goods to third parties, and the price of the third party that would be applied in order to adjust the price of the related party on the same transactions, if such adjustment would give rise to the additional tax obligations. And in the case of our clients, so in their selling generic products, because they're selling packaging products in case of the paperwork, the craft paper packaging materials, and they're selling both 80% to related party and the rest 20% to third party. And we need to making sure that is there any similarities in the goods selling to related party versus the goods selling to third party on the very first hand. During the preparations of our transfer pricing documentations. And as such, the factors that surrounding the goods, the specifications of the goods has to be explained properly in the transfer pricing compliance documents. For example, the manufacturing specifications, the contractual terms and conditions, as well as the others, maybe the shipping, the Incoterm, the FOB, and etc. It has to be taken into considerations during our analysis very carefully. And such difference that should be maintained as a supporting documents, and that's the supporting document in case the tax auditor, they are prepared to deem that the price of third party to the related parties. All right, and the second challenge, the second significant challenges that we normally see, well, this is the management fee. And the management fee that, for your information, the tax authority, they either hate the management fee as well as any, we call that the non-physical transactions. Maybe that we call it an intangible as well, and intra-group transactions of services as well, that should be in the very aggressive visions of the tax authority. Because if you are transacting all of the goods, all of the physical goods with all of the accounting records, all of the import and export records, and that should be very easy for the tax authority to examine. But however, for we call that the invisible or maybe the non-physical transactions, maybe services, royalty, trademarks, and etc., that you name it, there is no physical proof. And then the tax authority, they would be very aggressive in order, because in the mindset they would having a mindset that, okay, you are paying the management fee as a method that you are shifting your profit overseas. And in order to prove against the challenges from the tax authority, it is required that the taxpayer should prepare proper analysis and document the analysis in your compliant documents in order to prove that the ultimate goal of the proving method is that the taxpayer in Vietnam is the sole beneficiaries of the service management. Or maybe in specific that we have to state that there are three categories, there are three conditions that a tax authority they normally ask. The first one is that is the service provided directly bring up the benefit to the taxpayer in Vietnam. And secondly is that is in the same scenario is that all the taxpayer would incur of the intra-group services as well. And the third one is in order to prove that whether the management fee is conducted based on the arm's length or maybe the market price basis. And in the specific case of our clients, that the tax authority, the first one that they're concerned about is the fixed fee. Because the fixed fee is, for example, that you are charging the parent entity is going to charge the subsidiary about approximately $10,000 for a month. And that $10,000 that can be for such and such services, for management service, for ID service, for sales services, and etc. And what is the benefit that the Vietnamese taxpayer would receive? What is the breakdown? So in that $10,000, what is going to be the breakdown? So what is going to be for IT? What is going to be for management? What is going to be for sales support services, and etc. So that is the normal way that we normally advise our clients, well, and as well as our taxpayer in order to prepare sufficient documents as well as to prove the allocations basis of the management fee. Management fee is management fee is a very sensitive spectrum that the tax authority that reserve the right in order to put a very aggressive challenges on it. And beside all the allocations basis, they need to come up with all the supporting documents in order to prove that, and supporting documents over here to prove the arm's length, and to provide, normally is going to be the breakdowns on the cost. So what is the cost for example, what is the cost for IT? What is the cost allocations for IT? Is that based on the user, or is that based on some other allocation basis? And the supporting for sales, is that based on the sales revenues or maybe the sales volume or etc.? And again, all of the allocation spaces, supporting documents, as well as all of the further explanations, if so required, has to be documented accordingly in the compliance documents. And what is we call the benefit test. So at this stage, we would strongly recommend our clients or you attendees of our webinar today in order to look at back again. If you are incurring such, let's say non-physical transactions, let's go back and take a look and how the appropriateness of such transactions is going to be proved. Okay, and moving up. Okay, seems like we have some technical issues over here, so we may ask for your patience. Okay, here we are. And as finally, all the conclusions. We have been involving is the fact that we have been involving in the negotiations with the tax authorities. And it is, again, as we mentioned that before, the tax authority, they really hate the loss-making companies. Because of what? Because of your loss, is not utilized on the first year, is not the incurrent in the first year, you're not paying tax on the last year, but the loss would be allowed to carry over to the next 5 year or maybe five-year periods in order to deduct again the taxable income. So the tax authority, they're really not in favor, again, they're really not in favor of the loss-making entities. And of course, that is the loss that the client has incurred the loss, as well as their operating margins would fall below the market range. So after having all the tax authority, and we have been informed that the target of collections on the first hand is to make the taxpayer to have to propose any higher adjustment, and that the tax authority was actually aiming for the areas and the associated penalties and interest as well. In the absence of the compliance document, in fact, if the taxpayer did not prepare anything in order to prove the control transactions, and that would be a very favorable adjustment from the toward the tax authority itself. And they would be, it is normally to see that the tax authority, they came with a very high adjustment. But it is the fact that in case the taxpayer has prepared proper compliance documents, and the analysis that the taxpayer has been applied and documented under their compliance document will be used to explain and negotiate with the tax authority. And decree, and one knows of that, Decree 132 has also mandated that the use of the commercial database. So from now on, every commercial database, and that should be qualified by the tax authority, and every standardized financial information that would be used in the analysis that would be normally accepted, that is saying by the law. And at the end of the day, our clients, of course, as we mentioned that before, they have been making a loss, and which create a very aggressive challenges toward the tax authority, and the analysis could be a little bit unfavorable to them as well. And after all the adjustment of the negotiations that which mean GT and the taxpayer and the tax authority as well. So 3 parties agrees that there should be adjustment to be made, but not create any additional collections, any areas, any penalties and interest, but in order to reduce the loss carry over to the client. So at the end of the day, let's say, and then our client would share to us that this is a very statement that I would personally in favor a lot. And he would say the chief accountant, he was saying to me that during the transfer pricing is considered as buying the insurance for your business. In case the tax audit happened and we don't know how the insurance may help, but it may come to be help. It comes to be of help eventually in some other ways. And in this case, in absence of the compliance documents, and the taxpayer shall be taking out their pockets, and that should be aiming for the higher adjustment and resulting in the areas penalty and additional collections. But for right now, the only things that they might have at the end of the day is that they still have a significant amount of the loss carry over to use for the next year, while the rest has been adjusted by the tax authority. And they could accordingly use that in order to plan the cash flow for the next year as well. Okay, and having going through our my presentations and Thai presentation as well, and we would like to taking a moment in order to introduce our services, especially in the tax authority, when the tax authority, they pay a visit to your premises. On the first hand, if the tax authority going to announce that you would have a tax audit in the upcoming next few days, just becomes, and we would be able to help you in order to review all of the cover period under the tax audit and come up with our review in order to then identify the tax risk. And along with that, the recommendations for improvement and pre-audit assistance that we would be able to sit with you and sit with you and during and going through all of the negotiations, all of the explanations to the tax authority. And afterward, if the result does not sound favorable to you, and we would be very pleased to assist you in the further appearing service as well in preparations and obtaining the rulings for the tax authorities. And that was it. And our proposing to the service would wrap up the presentations from us today. And now we're moving up to the questions and answer sections.
Okay. Thanks, Dan, for a very interesting presentation. We got a lot of questions here, but due to the limitation of time, we only select one question for the tax and one question for the TP to answer live. After that, all the remaining questions will be answered later on via emails. Please understand for us. Thank you very much. So I have one question for the tax part is, how long would a tax audit take? Well, this is a very general question and very great question because all companies should be very concerned about this. So firstly, in theory, that a tax audit would consist of the following steps. Firstly, the tax authority will issue a decision on the tax audit. And after 10 working days, they will announce of the tax audit decision and perform a review at the company's site for a period of 10 working days. And after the finish of working at the company's site, after 5 working days, they will issue a tax audit minutes. So after 7 or 30 working days, they will issue the decision on tax administration violations or the conclusion of a tax audit if no violation is committed. So in totally, there would be a maximum of 70 working days to complete a tax audit. However, from our practical observation, from the date of the decision on the tax audit to the issuance of the decision on a penalty, there are some cases it would take only about 2 weeks to complete. So that is only in theory. How about in practice? The length of a tax audit would depend on the availability of the document requested by the tax authority. I mean, if the documents are available for their review now, or keep at a stock, or keep overseas sometime, and about the explanation of the company on the questions raised by the tax authority, or the complexity of the company's transactions, or the volume of the tax collection, the tax penalty after the tax audit. Okay, this is all the factors that will directly impact on the length of a tax audit. So for most of the cases, the working schedule of a tax officers can also affect the length of a tax audit, and sometimes a letter requesting for extension of a tax audit is necessary. Due to in the letter for extension, the company can say, okay, the reason is from the company by not making available the documents timely, or they are waiting for explanation from the mother company overseas, for example. So the tax audit in practice can lead from 1 month to 6 months, depend on a lot of factors like I mentioned above. So the next question from TB.
Okay, thank you, Tai, for passing that to me. And the next questions from TP that we would have beside the questions that we have already answered in the chat box. We have received several questions and or concerns regarding to the data of, let's say in generally the of the tax officer. So the first question is, will the tax authority provide us the data for the arm's length price range for reference? And the second questions that would have the same generality is that how can we clarify that the raise of the price of the tax officer provides is correct? Now, these are very great questions as well. We would like to thank you for your questions first. And again, as I mentioned previously, the use of the data of the secret database from the tax authority during making adjustment is that only in case the taxpayer has failed to present their compliance document that could comes from either they don't have the taxpayer did not prepare the local files, the local compliance documents, or they are prepared that using wrongful information and not qualified or maybe not authorized information. That is only, and that is the worst cases leading you to the violations positions. And that is the only cases when the taxpayer and when the tax auditor is allowed to deem your adjustment using the database. So that is because they need to reject. They need to reject your compliance document. They don't file the compliance document, or the compliance document is prepared in wrongful information. So that is, you are putting yourself into a very violations positions before the tax authority the tax authority to apply the secret database. So our recommendations is just be proactive and prepare yourself for the sufficiency of the documents. And as our clients mentioned that before, this is like doing transfer pricing is like putting yourself into the insurance contracts. We don't know what days would the accident would happen. We don't know what is the nature of the accidents, but when it happens, at least you have the legal basis, and at least you have a tax advisor and expertise or a experienced tax advisor to assist you during the appealing process. All right, and the second answers that we would have in here is that in order to determine the TPD preparations exemptions, and should we account for the loan par value into the cap of 30 billion related party transactions value? Okay, very good questions as well. We would like to state out the exemptions that in order to support the small and medium enterprises operating in Vietnam, the tax authority has created the filing thresholds in which the qualified taxpayer would be able to reduce their burden of proof by exempting from preparing the local the compliance documents. And one of that is that the taxpayer is having less than 50 billions Vietnam dollars in terms of revenues, and less than 30 billions in Vietnam dollars in terms of total value of related party transaction. And to answer your questions, it does not include the principal or maybe the par value of the loan. You just you just sum up the total revenue to related party, total cost to related party, or maybe total input and total output, and plus the interest expenses only. The principal would be excluded accordingly. And unfortunately, due to the time constraints of our webinar today, and we would unfortunately not be able to provide all the direct response to your questions raised below, but we would provide our response via email later on. And just please remember, before we end our webinar, and the presentation slides as well of the webinar recording and plus the Q&A sections we would be pleased to share them with you and with our attendees as well. And please also scan the QR code on the screen in order to receive the updates on the tax newsletter and event from our firm. And we are pleased to assist you in doing as our invitation for you to grow. And wrapping things up, and thank you very much for your time and your patience today in joining us as the webinar. And we hope that the webinar has been very sufficient and informative to you all. Yes, thank you.
All right, thank you very much, Mr. Khan and Mr. Tai from Grant Thornton. From us here, from the TBA Thai Business Association, thank you all for joining us. The team would do update, and please do keep in touch. Until next time, have a nice day.